Thanks for coming. Today's webinar is brought to you by the Women's Business Center and SESLOC Federal Credit Union. We're a nonprofit business center serving entrepreneurs in SLO, Kern, and Monterey counties. This webinar is being sponsored by the SBA, Wells Fargo Bank, Pacific Premier Bank, and the Governor's Office of Business and Economic Development. Their generosity allows us to offer this webinar and our free mentoring services to you at no charge. Thank you, sponsors. So I wanted to tell you a little bit about who we are. And the best way to do that is with our recording, because we had a great recording made and it says it way better than I could. So I'm just going to get that started here. Let me actually share my screen so you can see it. All right. There you go. Enjoy.
As an entrepreneur, I can tell you, I wouldn't be here today if it wasn't because of the Women Business Center.
We're getting all of these wonderful services, whether they're classes, courses, virtual workshops, one-on-one consulting and mentoring for free. It's invaluable.
The consultants at the Women's Business Center are just amazing people. Very caring people too, I've noticed. They all seem to be really empathetic and really kind, and they're really professional. Like they're actually doing these things in their own lives and they're making a living at it.
The Women's Business Center was really important for us when we were trying to make a decision on whether to relocate to the Central Coast. Coming to a small area like this, we didn't know if we would have professional resources or connections available. So we utilized the services of the Women's Business Center to help us learn about the community.
If I have any questions, if I have doubts, opening a business is not easy, but if you have the right support and the right consultant who's gonna be there with you, then there is no fear because they are there for you.
Who has that, like, how lucky am I to have that opportunity to have so much help given to me and so many people that want me to succeed, and they're all really nice to me too. I love that place.
All right, thank you so much. I just love that video. So I wanted to introduce our presenters today. I'd like to thank Carla Swift and Liz Summer from SESLOC Federal Credit Union for presenting. Carla is the Assistant Vice President of Education and Service Management, and Liz is the Senior Vice President of Business Services. SESLOC Federal Credit Union is a not-for-profit, depositor-owned financial services company headquartered in San Luis Obispo. Founded in 1942, it is the largest established credit union on California's Central Coast. Carla and Liz are here to help set you up for success, just like we are. We're all here for you. So before we get started, I wanted to run just a quick poll. It's a 30-second poll, so you can tell us how you heard about this so we can reach you again for the next one. So let me launch that poll. Well, my poll has disappeared on me. So you know what? We're not going to do a poll. All right. Thanks so much, guys. Carla, did you want to start?
Okay, I will take it off and then I'll turn it over to Liz at the end to answer all the business questions. But we're going to start with just a quick review of credit reports and what goes into them. And so I'm going to pull this up and let's see. Whoops, wait a minute, share screen.
Let me set that up for you.
Okay.
There you go.
Let's see. Oh, goodness. Here we go. All right. Are you seeing the correct screen here from me?
Yes, we are.
All right. And I'm going to turn off my video while I do this, because I'm going to not be making good eye contact. Okay. Let's see here. I am having to find the other side of my notes here. There we go. All right. So we're going to talk about understanding credit reports because it's such an essential part of your life and your business and everything. It affects so many parts of your life. And so today I'm really going to talk about the credit reporting process, the factors that affect your score, how to maintain or improve your score if you've had a problem in the past, and then how to dispute any errors because we know that they're rampant today. So I want to start by talking about financial health because that's really critical here. And so what is financial health? It means having control over your day-to-day and month-to-month finances and having the financial freedom to make choices that allow you to enjoy life, including starting your own business. And so the first component that we always talk about here is knowledge. And so today you're gaining knowledge about credit reports and how to manage yours. And the second part is skills and resources. So the resources we'll talk about are your credit report, you're getting your free credit report, and some of the services that we can offer you here at SESLOC. And just our business team is one of your resources. So feel free to come in and chat and learn more here. And so finally, having knowledge and resources will only take you so far. So behavior and habits is the final component. So we want you to build the behaviors and the good habits that will give you a strong credit report. And especially important is really making it a habit, because that's when you hit that sweet spot that we call resiliency. And that's the ability to recover quickly from unexpected circumstances, which we all encounter from time to time. One thing that might surprise you is that your credit score is not a measure of your financial health. It's actually a measure of risk. It's designed to tell lenders how likely you are to repay your obligations. And the higher your score, the lower the risk. So maintaining a good score is important, but don't confuse it with financial health. Your credit report is your financial history or resume. It tells a potential lender your credit story. There are 3 major credit bureaus, Experian, Equifax, and TransUnion, and they collect and store data. They're basically warehouses, and their job is simply to compile information given to them by the companies that you do business with, as well as from some public sources. And so the information that they compile includes current and past credit accounts, your payment history, including on-time payments, late payments, have you stayed within your credit limit, any accounts that could be in collection, any charged off debts. And your report shows whether you've recently applied for new credit or increased your credit limits on revolving debt, such as a credit card. Credit bureaus also collect data from public records such as court judgments and tax rolls. However, in 2017, a new law set higher standards that must be met before public records are included. And so Experian estimates that 96% of civil judgments would not meet the criteria and would not appear in your credit report. So that's a benefit for consumers. I'd also like to briefly mention check systems here. Although it's not directly related to your credit report, it can affect your financial life. And Check Systems is a consumer reporting agency that collects information about negative activity related to deposit accounts. It's commonly used to screen applicants before opening a new account, such as a checking account. A Check Systems report shows any deposit account abuses, such as unpaid negative balances, excessive bounce checks, and suspected fraud. And so a Check Systems is also governed by the Fair Credit Reporting Act. So just as with credit reports, you have the right to request and inspect your report and to dispute any inaccurate information. And I'll mention here too that some of this may be things that you're familiar with, but think about people in your life, maybe your children or relatives that could also benefit from this information, because I'm going to give you a lot. So if all this data collecting is starting to sound a little creepy, let's talk about the benefits of credit reports, because there certainly are some. Credit reports have the advantages for both consumers and for businesses. They reduce costs and they save time. So without automated credit information services, retailers and banks would have to call each creditor listed on your loan application. And of course, this would require more workers, more time, and ultimately it would increase the cost of borrowing for all of us. In addition, when lenders have reduced their losses because they get good credit information, this also translates into lower costs for you, the borrower. And because of this service, consumers have nearly instant credit. Any lender you contact can immediately check with this certified source of information and it speeds up the loan approval process. The other thing that's important is that it keeps information standardized so it's fair and objective. You don't have to worry that one of your credit references tripped over the cat, got splashed with coffee, and got a ticket on the way to work and was in a bad mood when somebody called to ask about your credit background. All this has led to the widespread availability of credit, which is good for all of us. And so, as I said, credit agencies just collect information. Think of them as libraries. They store lots of information, which they check out, meaning they sell to interested parties who have a legitimate business reason to know. Which brings us to the question, what are legitimate business reasons? What are the permissible purposes? Can a nosy neighbor get your credit report? Nope. The only people who can see your credit report are you and those with a legitimate business reason to use the information. And so these reasons include to open or manage a credit account. And of course, we all understand that lenders pull a credit report before they open your credit account. But what does manage a credit account mean? Well, once you have a borrowing relationship with a lender, that lender has the right to review your credit report, and they might do this periodically to evaluate whether to increase or reduce your credit limit to make sure everything is still stable in your financial life. A potential lender may also pull a credit report to evaluate whether to offer you credit, such as a new credit card. And you can opt out of this service. There's an opt-out service that prevents people that you aren't doing business with from actually pulling your credit. So that's something you can consider. When you set up utilities, internet, or cell phone service, the companies are allowed to pull your credit report. They want to see if you'll be a reliable payer. And although most states have laws that keep utility companies from denying you service due to bad credit, you could be required to pay a large deposit to make sure that, to ensure that you're going to be reliable. A potential employer or landlord may ask to see your credit report. However, they must get your written permission first. They will not see your credit score, and they must offer you a copy of the credit report that they receive. Credit reports are also available by court orders or subpoenas, and there are some business transactions that may permit a credit report to be pulled, such as applying for a government license or for a business investor that's interested in investing in your company. And then finally, one of the most important reasons is for your own review. So thanks to that 1971 Fair Credit Reporting Act, you have the right to review your credit report and to dispute inaccurate information. And you can receive this from each of the 3 credit bureaus once each year by going to annualcreditreport.com. Just as important as what credit bureaus store is what they don't store. Credit bureaus do not keep track of your buying habits or transaction data. Somebody once asked me in a seminar if shopping at the dollar store would hurt their credit report. And the truth is that credit agencies really don't care where you shop. We think it's a good idea to shop at the dollar store. So shopping at a thrift store or dollar store doesn't negatively affect your credit. Credit bureaus do not store criminal background, medical information, bank account information, or your income. Even your credit score is not stored at the credit bureau. So let's talk about how information is collected. Companies you do business with typically report account activity to the credit bureaus on a monthly basis. So as soon as you establish a relationship with a lender or another company, you become part of their credit reporting cycle. And it looks like this. You transact with the lender, credit card purchase, maybe it's a payment. They update their records. They share your history with the credit bureaus update your history, and it starts all over again. If you paid off a balance the day after data was transmitted, that would not show up until the next time the lender actually transmitted your information. And of course, all lenders are reporting on their own cycle, so information is flowing in and out of your credit report constantly. So I wanted to show you a typical credit report entry. Most credit reports will begin with personal data, including your name and address and former addresses, your employer, maybe your spouse's name. date of birth, social security number. So when you order your free credit report, that's the first place to start checking. Make sure everything looks accurate. But then check your account listings. And this is what a typical account listing looks like. It'll show the name of the creditor, a partial account number, the type of account, and in this case, it's an American Express revolving charge card that was opened in June 2008. It shows the account status. Is it being paid or paid as agreed, along with the current balance and the most money you've ever owed on this account. This person has been very conservative. At the bottom of this entry, you'll see late payments, which includes the number of times this person was late and the number of days late. And the status is the date the creditor last reported to the credit bureaus. And so all of these factors play a specific role when your credit score is calculated. And I'll explain how in just a minute. You may wonder, as I did, since I told you to check your address, what if you move? How does the credit bureau get your new address? Well, credit bureaus depend on information received from their information sources, which includes your address. And so when you update your address with your lender, they transmit it in the next reporting cycle. However, if you apply for a loan and the address on your credit report does not match the address on your credit application, the lender is required to take steps to verify your address and report any suspicious activity. And this helps protect you from someone fraudulently applying for credit in your name. However, if your credit report address doesn't match when you apply, it may indicate that you forgot to update your current lenders or your former lenders with your address. So make sure that you stay updated with all of the people that you transact with. So why does it matter? Well, to begin with, a good credit affects the cost of borrowing. If your credit report indicates you consistently repay your obligations in a timely manner, a lender is more likely to give you their best rates and their best terms. And over time, a better rate can save you a lot of money on a loan. For example, a borrower with a 5-year, $20,000 vehicle loan will pay more than $5,000 over the life of the loan if they have poor credit. So that's the difference between a loan at 3.5% and 12.5%. And the higher rate also increases the monthly payment over $86 a month for someone with poor credit. So that's what makes maintaining good credit really valuable. In some states, not in California, insurance costs can be affected by credit scores. A poor credit report can also influence whether a landlord rents to you or an employer hires you. So if you're leasing a building for your business, this becomes important. If your report shows you're not careful with money, it may be an indicator you're not careful with other things. And so it makes lenders or renters cautious. Sometimes here at SESLOC, our HR department tells me they have people come in and they have fantastic job interviews and wonderful skills, but they lose out in the final selection process due to poor credit, because that's important to us. Of course, here at the credit union, we want people that are responsible with money. However, a landlord or an employer cannot pull your credit report without a written permission from you. And if you're an employer pulling a credit report on a job applicant, you must have the applicant sign that release, and you must offer him or her a free copy of the report that you receive. Employment credit reports do not contain a credit score. So lastly, maintaining a good credit score helps ensure that you have access to credit when you need it. If you have an emergency and need to borrow, you want to be sure a loan will be available to you and at a reasonable rate. There are so many predatory lenders out there who are willing to offer you a loan when you're in dire straits, but it comes at a very high cost. In California, the rates on small loans can legally run as high as 459%. Yep, 459. You will pay back $4.59 for every dollar that you borrow. So again, this is why good credit is really important. So as I said before, Credit Bureau is just the library of information. It doesn't create your score. They rely on Fair Isaac and Company, what we refer to as FICO, to generate a score when a lender requests it. And FICO is basically a group of statisticians who have developed a scoring model that predicts the likelihood that you're going to repay your loan based on the information collected on your credit report. Vantage is a more recent scoring model that just emerged in 2006 as a joint venture of the three big credit bureaus, Experian, Equifax, and TransUnion. And it now has the distinction of being one of only two scoring models lenders use or rely on typically to make lending decisions. Again, credit bureaus don't create your credit score and they don't approve or deny your loans. They just store data until it's needed. So let's talk numbers. The differences between a FICO and score and a Vantage score are fairly minor. The cutoffs for each category are a little different, but ultimately your lender actually is the one who gets to decide what score they consider excellent or very good and so on. In hard economic times, lenders may tighten their policies, and in good times, they may relax them a little bit. So these scores are just examples, but they're in the range. Fair Isaac specialized in developing credit scoring systems for lenders and other businesses. The original or classic FICO score has scales that go from 300 to 850. They experimented with a score range from 150 to 950, but as far as I can see, the 300 to 850 model is the one most commonly used. And it just, again, really depends on the lender and what the lender asks for. And so the bottom line is all credit scoring models use the same information from your credit report to generate a score, but they treat the information slightly differently to meet the needs of a particular lender based on the lending situation. And so this is why I caution people not to get too caught up in the precise credit score number. The credit score number has meaning only to your lender and only to that particular transaction. And again, because your credit report is so fluid, that number changes regularly. Any credit scores you receive online are going to provide you educational value, and they can help you keep track of rises and falls in your score. They can give you an idea of how lenders will view your creditworthiness, but the score you purchase or receive online is not the exact score that the lender will ultimately use. So be aware of that. And also remember that lenders consider other factors beyond your credit score to make their lending decisions. So if you're not planning to borrow money, maintaining a good credit history is still important, but your actual numerical score shouldn't be your primary focus. All right, so having said all that, what does affect your score? Understanding these factors will help you take steps to optimize your score. And although negative information can remain on your report for 7 years, your score is primarily based on recent activities during the past 2 years. So paying on time is the most important factor. And with so many electronic options available, ensuring payments arrive on time has become much easier these days. You don't have to worry about mail delays or holiday mail delays, things like that. The next most important factor is your credit utilization or your total revolving debt. This looks at the amount you owe on revolving debt, not things like your mortgage loan. It's looking at things like credit cards, and it compares it to your maximum credit limit. It wants to know if your credit cards are nearly maxed out or do you have breathing room. So if you're always near your credit limit, this looks precarious, as if you're relying on credit for daily expenses. This will lower your score. So if you owe $900 on a card with a $1,000 credit limit, your score will be much more impacted than someone who owes $3,000 on a score with a card with a $10,000 limit. So if you're only $100 away from your credit limit, that doesn't look good, even if your balance or your limit is higher. So the best thing is to keep your balance significantly lower than your limit. 30% is optimum, but at least 50% or less. And a zero balance is even better. If you're an active credit card user and you get close to your limit each month, requesting a credit limit increase could work to your advantage, so long as it doesn't tempt you to get in over your head. Or you can also make payments more frequently to keep your balance low. You know, make a payment mid-month. The lender doesn't care. So pay attention to that. ideally you're using your credit card and paying off the balance each month. And the new FICO models that are just coming out are going to give additional credit for people who actually do pay their credit cards off each month and have a zero balance. So looking at the gray wedge over here, length of credit history is 15% of your score. And this is because new credit users have yet to prove themselves. Experienced borrowers get more points. So if you've had a lot of experience and you've been paying on time, that works to your advantage. Also, if you're thinking that you have too many credit cards and you're thinking about canceling a few, start with the newer accounts because those old accounts show that you have a longer credit history, you have more experience. The yellow wedge represents credit inquiries, so limit your credit card applications. Every time you apply for credit, it costs you a few points. So if you're applying for a charge card in order to get a store's promotional discount, you might want to think twice. Someone recently told me that she was offered a store charge card and they told her they didn't run a credit report, so it wouldn't affect her score. I think the store representative was being a little optimistic. That sounds highly unlikely to me. The exception to this is if you're shopping for a car or a home loan. FICO understands that you may be shopping for the best rate, so they count all inquiries within 30 days as if it were just one inquiry. And the last category relates to the types of credit that you've used. If you've had an installment loan, like a car loan and a credit card, that again shows that you can manage different types of credit, but it's the smallest portion of your credit score. So again, let me remind you, it does not lower your score if you order your own credit report from annualcreditreport.com. So don't hesitate to do that. Not all companies you do business with report to all 3 credit bureaus. So don't be surprised if you order your 3 credit bureau reports and they're not identical. Lenders choose which credit bureaus that they are going to report to. Some report to all 3, some report only to 1 or 2. And the other thing that you want to be aware of is that different lenders use different scoring models depending on the purpose of the loan. If you're applying for a real estate loan, for example, they might use a combination of all 3 credit bureau scores. And then they can also choose to use the lowest or the middle or a combination of all 3 scores. And so I know this is starting to sound complicated, but in reality, it's not something that we need to be terribly concerned about. However, even though this sounds complicated, there's more complications. That's because FICO scoring models have evolved over the years as credit usage has changed. So for example, the seemingly normal credit card use today would have looked like a high risk indicator 40 years ago. So just like your computer gets updates like Windows 8 to Windows 10, FICO updates versions of their scoring model as well. FICO 8 is the most commonly used today, but FICO Score 10 has recently been released, and each lender determines if and when they're going to upgrade to the latest version. But wait, there's even more to this. Lenders may request a different credit score version based on the type of loan they're offering. So they can choose FICO Auto Lending Score 8, 2, 4, 5, or FICO Bank Card Score 2, 3, 5, 8, so on and so forth. So you can see scores are not that simple. When we say check your credit score, it really should be scores because there's multiple versions. And so again, this is why I don't want you to get too hung up on knowing your exact number. I do want you to take care of your credit report so it's in good shape when you need it. So the primary takeaway is this. The key to having a favorable credit rating are the same no matter what. Make payments on time, keep credit card balances low, open new credit accounts only when you need them. So a quick overview: to maintain or improve your score, pay on time, keep balances low, keep your older accounts, they show you have experience. Don't open a lot of new accounts. Again, that averages in and makes it your experience score shorter. Pay off any older collection accounts that you may have. And sometimes people order their credit reports and they're surprised to find a collection account on their credit report. Sometimes it's just a small medical bill or other bill that was just overlooked somewhere along the way. So again, check your credit report and make corrections or make adjustments where you need to. So let's talk about goofs, because we have all had them. We've all forgotten to pay a bill on time, or maybe we just hit a rough patch and it affected our credit. But the other side of that is that credit reports often have errors. The latest number that I looked up from the FTC is that 34% of consumers find an error on their credit reports. So let's talk about both of these situations. What if you have a goof? Trust me, we've all made mistakes. We talk about our own mistakes here within the credit union. Just because we work here doesn't mean that we have perfect credit or we do everything perfectly. One of the things that is important to know is that there's no magic eraser to remove errors or mistakes or goofs on your credit. The errors can be removed, but not our own personal mistakes. Don't listen to folks that tell you they can erase bad marks from a credit report. If the entry is correct, it's going to stay there. But the good news is that time heals all wounds, even credit report wounds. So scoring models place the most emphasis on the past 2 years, as I mentioned earlier. The more distant the negative entry, the less impact it has on your credit score. And there's more good news. Positive accounts that remain open continue to be reported. A closed account typically drops off after 10 years. And another positive change that has recently happened for consumers is that the 3 major credit bureaus recently implemented a 180-day waiting period before medical debt can appear on your credit report. This is one of the most common problems we're seeing today, as people do run into medical debt and it's damaging. The 6-month grace period that this is designed to give you enough time to correct errors on your bill, or maybe get your insurance company to pay it, or to work out a payment plan with your medical provider. Unpaid medical bills should not appear on your credit report unless a provider turns it over to collections. So when do those negative entries drop off? Late or missed payments will appear for 7 years. Chapter 7 bankruptcy for 10 years, collection accounts will appear for 7 years. But here's some more good news. Revisions to consumer protection laws prevent a collection agency from selling a debt to another agency in order to extend the time that it remains active. You'll see here that the 7 years is from the date of the first delinquency with your specific lender. And so that's a little loophole that got closed recently. Someone once asked me, if I make a payment on a collection account, have I extended the 7-year period? And I didn't know the answer. So I chatted with a certified credit counselor at Green Path Financial Wellness, the group that SESLOC works with. And she said, no, it will still drop off your credit report after 7 years. However, a payment restarts the clock on the statute of limitations for lawsuits, meaning a collection agency now has longer to file a lawsuit against you. So if you're going to make payments or you're going to pay something off, it's probably better to do it in one lump sum. And I also should mention that if you ever want to chat directly with a certified credit counselor, SESLOC works with Green Path Financial Wellness, and tell them SESLOC told you to call. You have free access to any financial information that you need, and even coaching and advisement. They'll help you with that. So you hit a rough patch and your credit score suffered. How do you recover? Or maybe you have a young person in your family who's just beginning to establish credit. What do they need to know? Well, if you have old debts, pay them off. Sometimes you can make payment arrangements with the creditor. Sometimes lenders will settle for less, but this usually requires a lump sum payment. And if you know anyone that's considering this kind of thing where they make a settlement, it's important to know that if a lender writes off a debt, if they settle for less than you actually owe, it is going to be reported as income to the borrower, and they will be paying income tax on that at the end of the year. They'll get a 1099-C form that's sent to the IRS, and you'll owe income tax. When Building or rebuilding credit, a credit card can be a good way, or a secured credit card can be a good way to get started. The card limit is secured by funds in a deposit account. Basically, the funds get locked in and it is your promise to repay. And so lenders are very generous in offering you a credit card as long as it's secured. New credit card users could also benefit from a co-signer on a loan or a credit card, or even someone that's recovering from a poor credit score. However, keep in mind, if you co-sign for someone, such as one of your kids, any late or missed payments that they have will also affect your credit score. So use this option with caution. Don't be too generous. And then again, when you're rebuilding credit or establishing credit, paying bills on time is the most important thing that you can do. The latest 2021 statistics show that 1 in 3 people have at least one error on their credit report. An FTC report said that for some people, fixing an error resulted in a 25-point difference in their score, and in rarer cases, a 100-point difference. So it's really important to know your rights and to use them. In the 70s, Congress passed the Fair Credit Reporting Act, which gives you certain rights, which includes the right to have your account corrected. Can you imagine that before that, you didn't have that right? The right to review your credit report every 12 months. You also have the right to a free credit report if you're denied credit based on information in your credit report. You can get a copy of the credit report on which the decision was based, and the lender will tell you which credit bureau they use so that you can contact them. It's super important for you to understand that you cannot remove accurate information. Any negative information that's supposed to be there will stay 7 years. You just have to be patient and wait. However, remember, I said your credit score is not the only thing your lender relies on. Well, lenders know when unusual economic situations have impacted consumers. The 2008 recession was one example, and of course, the pandemic is also having serious economic impacts. Lenders may take that into consideration when they're reviewing your credit report. And they can tell from your credit report if you're recovering or if you're sliding downhill. So the important thing is that after a setback, get yourself back on track as soon as you can. So let's talk about where errors come from. Well, first, similar names. If you have a very common name, or if you're Mary Smith Jr. or Sr., you may find your mother or daughter's information on your credit report. Also, inconsistent use of your name on credit applications can cause problems, and we've seen this here at SESLOC. Don't be Susan R. Taylor one time, Sue Taylor the next, and Susan Regina Taylor the next time. Choose a legal name and signature and stick to it. Sometimes typos happen. Handwriting isn't clear, or somebody enters your information incorrectly. And merchants also make mistakes. A former employee told me that she had always saved up to pay cash when she bought a new car, but she went in to get her next car and a dealer offered her 0% financing, and she thought, well, why not? I'm going to invest my money instead. I can earn more that way. So after 3 months, it made her a little nervous, and she just said, oh, heck, I have the money. I'm going to pay off my car loan. But much to her horror, when she ordered her credit report, it appeared as a charged off loan, as if she had defaulted. This truly was a serious credit reporting error. So you just never know. It's just odd things that happen. Companies that close sometimes will sell your loan to another lender, and sometimes both lenders will appear on the credit report, making it look like you have 2 loans instead of 1. So it's important to dispute those errors. You should contact the credit bureau that is showing it on your credit report. Credit bureaus have forms on their websites, and when you go look for those, you can also provide any documentation that you have. And anytime you have contact like this, save copies of everything you submit for your file. Keep notes on who you spoke to if you make telephone calls. The next step is to contact the creditor who may be reporting that error. Call the billing phone number, not the customer service number, and be courteous but firm. Explain the situation. Remember, you're asking for their cooperation. If you get somebody that's cranky and doesn't want to work with you, call back another day and speak to someone else if you have to. And again, remember, Credit bureaus by law cannot remove accurate information. If it's correct, it's going to stay there. There's nothing anyone can do to get that removed, no matter who promises you what. However, creditors can change their reporting if there's a legitimate reason. So if you're negotiating a settlement and you say, well, if I pay off this loan in full tomorrow, will you also remove it from my credit report? They can do that for you. So never be afraid to ask. So if you have a dispute, here's the timeline. Let's say it's Experian. They have 30 days to verify the information that they collected. They will contact the creditor reporting the information. So we'll call them XYZ department store. XYZ department store must either verify the information or update their records. If a correction is needed, that XYZ department store is required to report corrections to all the credit bureaus. So that helps protect you as well. However, if Experian Credit Bureau is unable to verify the information from XYZ department store, they must remove it from your account until they can verify it. If it turns out later to be correct, it will go back on your report. And this is one of the tricks that some of these credit cleanup agencies use. They'll dispute something and you think it's been taken off your report and finally it's ultimately determined to be correct. You've paid this fly-by-night agency to clean up your credit report and now the item is back that you thought that they had removed. So be careful about that. So what if XYZ department store says the information they're reporting is correct and you disagree? You have the right to submit a statement of dispute to the credit bureaus and have it attached to your credit report. Any lender receiving a copy of your credit report will also see your dispute statement. I should also say that sometimes it's maybe you're not disputing it. Maybe you just have an explanation you want to add. You know, I got COVID and I was in a coma for 2 months and didn't make my payments. Could be a legitimate excuse that you would like a potential lender to see if they see that late payment. The bottom line is be patient. You need to allow at least 60 days, 30 days for an investigation and another 30 days or so for it to run through a complete reporting cycle. So the information gets removed. And this is why it's really important for you to check your credit report for errors well in advance of applying for a loan, especially if it's something like a home purchase. You don't want your deal to fall through while you get an error corrected. So again, the place to get it is annualcreditreport.com. So again, let's talk about those credit repair offers. You have undoubtedly seen the ads. The one that annoys me the most these days is that deep voice that says, we have information the credit card companies don't want you to know. And for somebody feeling desperate, statements like credit problems, no problem, or we can erase bad credit, that can be really tempting if you're feeling desperate. The Federal Trade Commission says, do yourself a favor, save some money, don't bite. Attorneys at the FTC say they've never seen a legitimate credit repair operation making these kinds of claims. And so the fact is that they can't legally do anything that you can't do for yourself. And what's worse is if they do something illegal, you can be held liable. So take the steps you need to take to dispute outdated or incorrect information. Just do it yourself and save some money and some heartache. So just to wrap up, I want to talk about some credit report myths, and then we'll have Liz talk more about business lending. Myth number one, when paid in full, the bad debt will no longer appear on my credit report. Unfortunately, yes, it will. But again, as it gets farther in the rearview mirror, it counts less. The credit reporting company denied me credit. Nope, the loan decisions are based on the policies of the lender. I'm not responsible for those charges on my spouse's account. Well, sadly you are. California is a community property state, and that means you get to share the debt even if your name isn't on the account. You share everything. So my recommendation to couples is one person should never have a higher balance than a spouse could afford to repay if something happened to you. A divorce decree separates joint accounts. Unfortunately, no, it doesn't. You can divorce your spouse. You can't divorce your lender. You sign the papers and the lender will come after you no matter what that divorce decree says if the person responsible isn't paying. Consumers must give their permission for a report to be issued. No, not in some cases. Some businesses will request your credit report, and it is a soft inquiry if they're just doing it to offer you credit. Maybe you don't do business with them already, and that does not impact your credit score. If someone actually does a hard inquiry, now they're legally obligated to offer you credit, but we're not seeing as many pre-approved credit offers coming through the mail as we did at one point in time. And again, requesting your own credit report does not harm your history. And the myth number 7, there's only one credit risk score and it's on every report. And as I said before, this is false. There are so many different FICO scoring models and Vantage scoring models, and a lender can choose the one they prefer. However, all scores measure the same things. They just weight them a little bit differently. And so paying on time and keeping unsecured debt low are always the top considerations. And then together they comprise more than half of your credit score. So regardless of which score the lender uses or which report they ask for, those are the 2 key things that you need to keep in mind. So lastly, one of the best things that you can do for yourself is to build a savings safety net. We tell everyone, pay yourself first. In other words, treat your savings account like a bill that you must pay every month. Consistency is the key rather than the amount. Having that cushion can help protect you when the unexpected happens. And again, you know, we all felt that unexpected a year ago when we all got sent home to work remotely during COVID, or people were losing their jobs and incomes. And so make that a habit. Make it, continually grow your savings account. It's really your cushion for the unexpected, because emergency borrowing can be costly. And wouldn't it be better if you could borrow it from your own savings account and then pay yourself back? And so with that, we can stop. Liz, I was going to have Liz talk about what happens. I made a slide for her, and I'm not sure if I got what she wants to talk about correctly, but by all means, Liz, why don't you talk about what happens at SESLOC when people come in for a loan and how their credit reports are important to that and that sort of thing.
Can I interrupt for just a second?
Yeah.
Great presentation, Carla. Thank you. You have a lot of questions that have come in.
Oh, good. Okay, let's ask.
And it looks like you answered actually a lot of them. I encourage people to type them in as they thought about them. And so you did actually address most of them. I did want to have a chance to get to those, but I want to have Liz speak as well. So I think what we'll do is have Liz speak, and then we'll address the questions that we can, and the ones that we don't get to, you and I can talk, and I will send them to the people who are asking them.
That sounds perfect. Yes.
Perfect. Thank you. Go ahead, Liz.
Thank you. I just suddenly went blurry and I'm not sure why, but anyway, you can see me, sorry about that. But I just want to bring out a few important points when you do look or approach a financial institution for business loans. Business lending and consumer lending, as probably some of you have encountered, are different. There's different requirements. Ironically, the less money you look to get from a bank, like let's say you want to get a small credit card, we have a program, other institutions in this area do too, that are for small dollar amounts. It will sometimes be based on your credit score. That's when it's really important that you are aware what your credit score is. You have a good handle on the number roughly, even though it will be pulled, because it can make a difference whether you'll qualify for one of those much needed smaller projects or products like $5,000 or $10,000 for a credit card. One thing that I do personally is again, Carla didn't touch on this, but I freeze my credit. That way, if you are talking to someone, you have to give your permission to let your number out. And that's important. In the past, I too was a victim of identity theft. And so I'm very careful with my credit score, and I rarely give it out just for an application of credit, like a refi of a mortgage or something like that, or if there's a credit card or that I want to apply for. So that's something to remember as well. So with your credit score, it's very important. The larger a loan is, when we get up into large loans with commercial buildings and such, yes, we do pull credit. We do look at that, but we're also looking at personal financials as well, including the business financials. And that's something I want to talk about as well. Really have a good handle on your personal financial situation as well as your business financial situation. Know what your accounts are. Have that information readily available. Your accounts, the estimated value of them, your checking accounts, savings accounts. If you by chance have a 401k or a retirement plan you maybe brought over from a business you had worked at, keep track of all of that, know where it is, because that's all necessary information when you're looking for a business loan. You need to give as much personal information about yourself and your financial health and well-being as well as your business. So it's always important to remember that. And if you're in business with other people, if you have partners, it's important that you're aware of their financial situation too, especially if you're going to go in and apply for credit together. You need to be have an honest and open discussion with them if there may be something that will be found on a credit report or that will be coming up in your discussions with the banker. So I'm speaking very, very generally because I know we're coming up on time too. But and also when it said documentation, that makes it depends on what kind of a loan that you're going for. Even smaller loans will look at tax returns. And so again, you need to have that information available, your personal financial returns, as well as your business financial returns. And you'll get a financial, personal financial statement. Banks have within their applications, they'll ask you to list everything, and same with your business, and debt schedules as well. So even for the smaller loans, you still have to have your house in order, just like you do as you go up into larger loans. And one item that Carla touched upon when getting credit, let's say something has happened in the past and your credit score, you're in the process of rebuilding it. For credit cards, for operating a business, it can be really helpful, especially if you ever need to travel for your business or reserve hotel rooms or whatever. You have to have a credit card. There are secured credit cards, and institutions will do that quite often. If you have funds available, you can put it into a CD and they'll anchor that credit card with the certificate for deposit. That's a secured credit card. So there are ways to get credit cards when you're in business, even if you do, even if it's a small amount, let's say, $3,000, $4,000, $5,000, just so you're able to use that credit card in order to operate your business. So that's about all I have, and we are coming up on time. So are there any other questions? I should look at the chat and see.
Thank you. That's wonderful. Both of you guys, Liz and Carla, really great information. I've been playing the credit game for a very long time, and I tell you, I learn something every time. So thank you so much for presenting. We do have some great questions. I think the one that stands out that I will get to the others later, and so Carla and I will talk, and I will answer all of your questions. So don't despair. But somebody wanted to know if they have been affected by fraud, how can they repair their credit report?
I think the main thing on that is just making sure that you contacted the credit reporting agencies to notify them. It's a lot of work. And Liz, you've been affected by fraud, so you've had that experience.
Yeah, you have to be, and you have to have patience. It takes, a while. You have to work with these organizations, and you may be asked to, write letters, supply other information, provide proof. And it is a process, and it involves patience. And when you do have your identity stolen, it is really, it's quite upsetting, and you have to really keep copious notes of all that, all the information, everything being told to you when you talk to different agencies, and go through all the steps they tell you to go through when it occurs.
Yeah.
Thank you so much. You know, I just got a note today that somebody was trying to use my credit card to get a Lyft ride. So unfortunately, they're not getting their ride. But the way I found out was that I had, you know, my credit card tells me every time it's used. So that's another thing that you can set up to help keep track of your things.
Yes.
So I want to thank you all for coming today, and Liz and Carla, thank you so much for presenting just such wonderful information. We have more webinars coming up regarding, oops, I don't want to stop that. Yes, I do. We have more information about money to help you all at the end of the year. We thought it was important that we help you get your financial health in order. So we have How Money Works. That's long-term money health. And that's a two-part series. So part 1 is on the 12th of November and part 2 is on the 16th. I encourage you all to attend. I will send you the registration links in this follow-up email, and I will send you the answers to the questions that you've asked in an email as well. That will be a separate email after Carla has answered those questions for you. So thanks so much for coming. It was great to see you all. Have a great day.